Hi guys, this is Boom Traders, and we're gonna do the weekly overview video for week 24, 19th of June 2022. I'm TinTinTrading, and I'll go over this video with you. The way we do all these sessions is we're gonna review the two models that we issue, then we're gonna go over the relevant current market conditions, and at the end we're gonna finish with a summary. Now, if you followed our videos in our video series, look, we've been very cautious all the way while the market has been making lower lows. And this video is going to be quite fast because there's not much that we've seen different from the previous weeks. Now, first, the risk-based model has turned negative. It's been on sell signal since 22nd of November. We did have a really short buy alert on the 26th of May. But since then, what we see and the things that the risk-based makes, which are the general market, the up and down volume, the new highs, new lows, and the stock participation, have all turned negative. So this is maximum bullshit on this signal. From then on, the tactical trading environment has also gone on red. And this has been on red since 10th of June, which means that the breakouts are not working well and maximum caution is advised. This, of course, is relevant to our methodology of trading, which is the momentum breakout trading. If we look at the SPY that we've been making lower lows all the way down to here. Now, last week was important because we did get the additional Fed hike of 75 basis points, which was anticipated. If you look, we marked on the chart every time that there was a Fed hike, and we can expect actually moving a bit further down here. There were two things that came out of the Fed meeting. The first one was that the Fed was very clear that it would battle inflation with whatever tools that they have on their hands. And even if this means slower economic growth. So that's definitely not good for the stock market. However, what we are seeing and the way we are reading this and the moves that the market has made to digesting this is that stocks are already discounting the lower probability of soft landing. We believe that the stock market is a forward discounting mechanism. So all the news that are out are already priced in. So we believe that stocks are already pricing in this lower probability of soft landing. So if we land into a recession, stocks might actually have already priced that in and not have very strong overreaction to these type of news. Now, we are also seeing some good signs over there. And apart from stocks, which kind of price that information in and are going down, we're getting a few other things that is showing to us that we might actually be ready to battle this inflation and might not get into recession as many are fearing. Now, these are the indicators that we've looked, and these are how they're moving. So the Fed balance sheet is no longer increasing. Consumer sentiment has gone to record low. The LEI has decreased. Industrial and manufacturing productions are both slowing down. Retail sales are really low, and the May housing has started to fall while the building permits have decreased to 7%. So all of these are good signs, and they're good signs that we might have battled inflation or that inflation has actually going to take a breather here. A worrisome sign on the market are 10-year treasury yields. And we've also mentioned that before, but the 2% here was a big mark that we were looking at. As you see, this nice perfect VCP that came up to here, and after it broke out, there's consequent inverse relation into the performance of the stock market. We're not seeing this coming down in any meaningful way. It's currently at 3.25, so we will definitely want to see this moving consistently lower to the pressure of the stock market. The ECRI that we're looking at is currently reaching minus 10%, which is one of the first signals that might be forecasting a negative GDP growth, which in essence means that increases the likelihood of a recession. So that's also a problematic area that we want to see either move up from here or at least not violate and go further. From then on, we're actually also seeing a few other good points, which are showing that inflation might not increase as much as we are anticipating. Oil has actually gone down quite a bit since beginning of June. So that's definitely constructive. And energy as a whole has, after making this really nice move up, and this is the day when we alerted it in the Discord room for a play to the upside, we took profits midway across the move. But since then, we're seeing this really big overreaction. And as you see, this is in the past year or so, this is the largest down week that we have experienced, which is definitely a warning sign if you're trading it, but actually a good sign to see that prices are likely to be coming down. So that's again in the bucket of positive signs for maneuvering the soft landing that the Fed has anticipated. On top of that, we wanted to share with you that we are launching a new tool in the Discord in the advanced section. We call it the Market Overwatch. There'll be 3 different subcategories here, but this is the general one whereby we look at different sectors. We'll go into much more details about how to use this, but the point I'm making in this video is that we're counting confirmations and violations, and we're seeing that on the 4th of June, we had a really bullish overlook of the market with a lot of confirmations coming only 10 days apart. We're seeing actually quite a lot of bearishness and bearish technical moves, which have moved most of the sectors into the negative territory. Again, much more information about this is going to be launched in a separate video, but this is a great tool and something that not many traders have in their arsenal. So looking forward to sharing this with you. Now, another thing that we've been looking at are the volume markers. And in essence, we're looking at the ratio of down volume to up volume in the mid-cap stocks of the S&P. And what we're seeing is that we're getting a few signals into this, what we call the problematic zone. This means that the down volume has outpaced quite a bunch the up volume. Now, you can't take this just as a bad sign, because what you want to see and what you want to understand is that on the way down, while the stock market is making a bottom, the kind of final leg always comes on this very increased aggressive action. Bottoms, it's bottoming in capitulation fashion. So this is not, in essence, a bad sign. We are likely going to see this on the bottom, but we need to make sure that this is making some stalling action or participation into a rally. Just remember that selling pressure is increased at the end of a capitulation move. From there, we have to be very aware that there will be increased in volatility, and it's going to be elevated until we get the sign of lower inflation. Now, two statistics that we wanted to share with you is that in non-recessionary periods, rallies from this kind of downtrend are going to be between 5 and 8%, 70% of the time. So 70% of the time we'll be getting these kind of rallies. So that's increasing in volatility. For the other 30% of the time, the rallies that we will be getting will be about 10 and 15%. Why is this important? It's important for you to understand this because if we are getting into a short position, for instance, anticipating that the market will go down, these rallies will be very painful to withstand. That's why our methodology is asymmetrically skewed to trading to the upside and trading from low volatility to high volatility environment. Whereas if you trade within the high volatility environment, the moves are so aggressive that either way you wouldn't be able to participate and use tighter stops. Now, if we are in a recession, we might be getting a downtrend rallies of anywhere between 20 to 25%. So again, this increase in volatility would very much position the breakout trader to the sidelines, whereby he would wait for a much better environment to trade in. From then on, if we look at the McClelland oversold markers, we are looking at 3 of them: the volume marker, the normal McClelland oscillator, and the summation index. And so far, only 1 of the 3 is actually showing an oversold condition, which again could be somewhat worrisome. We are quite a long way down from when we started advising cautious, which was at the end of last year. So just beware that when we have this sell signal in action, breakouts are likely not going to work, and it's going to be a tougher period to trade in. And therefore, again, if we talk about the different periods, we are very much here. We're in the super bearish, volatile environment, whereas we want to get aggressive into this easy dollar environment, which when we do, we will hurt you in the service. Finally, we showed this checklist a few weeks ago about the signs of making a bottom in the bear market. And then we were getting a few green lights that we might be getting this bottoming action. Currently, apart from the extreme bearishness, we're not seeing much else. The stocks are not setting up. There is no follow through days. The breakout levels from the stocks are not working well. Many of the breakouts are actually squatting, and we're seeing pivot leaking, as we call it, and the momentum trust and confirmation are also not working well. The percent of advisors that are issuing bearish advice has actually gone to that 40 mark that we've been looking at. But at the same time, if you just open your FinTwit, you would see that there's still a lot of people saying that this might be a buying opportunity and advising to buy the dip. So from then on, in a summary, the risk vest is on sell alert, tactical trading environment is red, we haven't seen any follow through day, volatility is increasing, and there is no traction or confirmation into the general market. As we say, cash is king, but this is definitely not the place for you to go away from the market. In essence, as you saw within that slide on the YouTube, things can change very quickly in a matter of a day, 2-3 days, even up to a week. So just keep on looking at the market. This will be a great buying opportunity, but currently it is not. And you want to get on those leaders as early as possible. Hope you enjoyed this and see you in the Discord room.